Long-term wealth drivers, where the money is made and what it actually makes you wealthy. The cash flow is actually the fuel to keep that engine running, to keep that vehicle for long enough until you move on. But the real wealth is made with these 5 drivers that will build your wealth over time. It may be like in 1, 5, 10, or 20 years or more, depends on the exit strategy. And those 5 drivers are the cash flow, hang on for it, I'll break it down, the principal pay down, the appreciation, the income increase, and tax benefits. Also, I'm gonna give you the 6th one as a bonus. Stick to the end. Now let's break it down, the cash flow. You may ask yourself, isn't that just the fuel to have the vehicle running? Yes, it depends how you are treating that cash flow every single month. Let's assume you are getting every single month into your bank account a pure cash flow $300. What you're gonna do with those $300? You can spend on things, you can spend like a very nice restaurant, you can pay for your lifestyle, and so on. But you also can use those money as one of the drivers to build your wealth over time. You can take the same $300 and reinvest them and have the compounding interest to build over time. So what I would do, I'll just take those $300, put them in a mutual fund or anything, or maybe an index fund, and then you might have like around 7 to 8%, and just do that religiously every single month. It grows enough that you can use those money later on and buy another investment property, right? Or maybe you just do well enough that you keep it, and the velocity of those money in that account is just gonna build up over time, and the compounding interest is gonna kill it. The next driver is principal pay down. So imagine that you have that investment property, you put a tenant in place, and that tenant is gonna pay you your loan every single month. And usually how it goes, if you have like a fixed rate loan for, let's say, 30 years, every single month it goes more in the principal paid off and less in the interest, which helps you to pay that loan faster and faster and faster. And in 30 years, unless you are paying more maybe principal every single month, or maybe if you sell the property in the meantime, in 30 years you have that asset which is owned free and clear. So the tenant paid your investment off, and by the end of the 30 years you own that asset. And let's say you bought a $500,000 home, even if it didn't go in appreciation, anything, in 30 years when you are about to retire, you own $500,000 free and clear. And some people may say, like, those landlords, little jerks and so on, because they make money of those tenants, poor tenants that live in that home. I'll just put it this way: if that tenant is living in my investment property, I just provide housing for people who cannot buy a home for themselves, but they make enough to pay the rent, and they're happy about that. Also, there are people they don't want to buy, they just want to rent. Or maybe there are people that they have a better investment, let's say maybe like a business or anything like that will outperform the investment in real estate. They'll just be renting. They can rent from myself, and they will just be running their business and making more money out of that business because it makes more sense for them. And to those tenants who live in my rental properties, I'll just tell them, you know what, as soon as you can buy something like a home for yourself or for your family, you just move on and buy that property by yourself and build your wealth into that property. You don't have to pay my rent, because there is going to be another tenant who needs my place, and they'll come back and they'll just rent from me. Now let's talk about appreciation. I won't go hard on that because you don't know how the market is going to be having the next 5-10 years and so on, but historically there was like appreciation between 3 and 5%. It also depends what kind of market you are in and what's the strategy for that investment. But let's say this way, for the appreciation, if we have like very conservative numbers like 2-3% or maybe 5%, whatever the number is for your local market, let's say we have the $500 home, and maybe over a few years, and not saying in a year or two, but maybe over a few years it appreciated for another 10-12%. And if we invested, let's say, to $60,000, and if in a matter of a few years appreciated to 10-12%, so that means that investment made another $60,000, which is 100% return on my money, because when I bought it I invested $60,000, and in a few years it made me another $60,000, so that means that I made 100%. I don't think there is another vehicle that will give you that good of a return unless you own a business, you know how to scale that business, and not just scale, but scale exponentially, at that point probably that business is gonna outperform the investments in real estate and stocks and any other vehicle. Other than that, I think the real estate, for especially for the beginners, is the best vehicle to start building your wealth over time. Another driver is income growth. This is actually your rental that you'll charge your tenants every single month. Let's assume you understand well your location, your market, and if your market supports that you can increase the rent every single year, you'll be increasing the rent for those tenants. So that gives you better cash flow, improves the return on that investment overall. Another thing you keep in mind here, that there are like fixed costs. If you have a 30-year mortgage, so usually the principal and interest doesn't change, so it's gonna be the fixed cost over 30 years. There could be some variable costs like taxes, insurance, maintenance, and so on. Mostly in those situations, those costs won't go up as much as the rent goes up. So usually rents will outpace the expenses at that point. So you'll have to keep in mind that you understand all those numbers and how those work, because it may start bleeding every single year. You may still start losing money from the cash flow, even though the appreciation may offset that. Anyway, you may bleed money every single year. And especially if you are in a market where the rents will stay the same, you have to factor in if any of the expenses go up, so technically you start losing some money on that investment in that particular market. But if you are in an appreciating market, so those numbers will work differently, because usually rents tend to go up, but not that much as the appreciation. Even if the expenses will outpace the rent that you'll be charging, even with increases yearly, the appreciation will offset all that. Because let's say if you want to buy a property in an appreciating market, like over time it goes that much that usually like the gap between the rents going up and the appreciation going up, it's bigger and bigger. So if you want to buy in a higher market, usually the rents won't even cover close to the expenses that you'll have on that high appreciated already property. And the fifth vehicle is tax benefits or tax advantages. So usually it will include depreciation and write-offs, and depreciation is also a part of the write-off. So technically IRS will allow you to write off that building over time. There is like more complex structures like cost segregations and so on, but we'll keep it simple for this video. IRS usually will say, so this property, basically, if you bought it now, usually in 27.5 years, you can write off over like 27.5 years. And I'm assuming it's a regular investment. There is no cost segregation or anything complex. That's a discussion for another video. Also, you can write off here like other expenses, including like interest that you're paying to the bank, if you've done any capital expenditures, any repairs, if you have any fees, and so on. So you can write off all those expenses associated with running and holding and carrying on that investment property. A full disclaimer, I'm not a CPA. Make sure you consult a professional in the field, because your situation may vary depending on many variables involved. Quick note I want to add here. So some of the investors, they will treat the investment properties as a shelter to offset their income from that investment, or in some situations even from other fields of activity. For instance, if I'm a real estate agent, I may still offset a part of my income with the depreciation which is covered from that investment property, and offset a part of my active income and not to pay legally that much taxes on my active income. And there are people, investors slash business owners, they at the beginning of the year, they'll sit with their CPA strategist, they'll run the numbers, and based on the projected income they will have this year, they know exactly, even at the beginning of the year, how much of those investment properties they have to buy this year. So which is a pretty good strategy to have it, and government allows us to do that because they don't want to provide shelters for people. So that's exactly why they give us those incentives for us to do it. And the sixth one, which is a bonus, technically it's not one of the drivers, but it's mostly associated to one of the drivers. I would consider it more as a tool. So that's leverage, because I don't think there is another business will give you like 90%, 95 or even 100% of the leverage, that I can use bank's money to buy that investment property, right? I get to benefit all the upsides, and bank has to carry a lot of the risk as well. Yeah, definitely, if you don't do like a good investment, a good underwriting and so on, so probably they won't lend you money. But let's say you've done everything correctly, so use 90% or maybe 80% or maybe 100% of those money to invest. And that's my favorite part, when I use their money to build my wealth, especially at the starting point when the resources are limited. And now speaking about the return on the investment property, when you have that cash flow, it's not only the cash flow. When you factor in all those drivers together, like the overall return on that investment, that's probably going to be a killer deal if you are holding long enough. And it also depends on the strategy and the plan and the exit plan that you have for that investment.